A small 25 basis point rate cut. We'll move away from US. We'll move away a little bit from Japan as well. We discussed Japan at length last time around. This time we'll focus more on India because the next set of opportunities that we feel are in India. So right now, Indian economy, as we've been discussing across the last few months, that they have been in a Goldilocks situation. There are a few creaks here there, but overall, if we keep waiting for exactly like the perfect moment, it does not, like, you're pretty late into the cycle. So all that we have to look for is basically any green shoots that are available. We've been discussing across time that we've discussed across time that India looks like a very good place, and thankfully, as we'll see along in the presentation, we've been blessed with decent business surveys now, and the street is pretty slow right now. So that's like a perfect opportunity to get in, and we'll continue to do this entire theme across today's session. Before we get started, this is like the disclaimer. I would just give a moment here to just read through. Basic understanding here is that anything that we discuss is just for information purposes. We do not intend to advertise or promote anything. Any of the stocks discussed are for illustration purposes and are not recommendations. Moving on to the report card that was there last month, we saw that the largest gain actually came from US, and this was majorly bought into by a lot of retail participation that we've actually seen. The last 1 month, US, the Dow Jones Index itself has been up 3.5%. The entire last 6 months has been up around 19% and it's been one of those larger performers between the US and China markets have been the better performers out there. India, as I said at the beginning, absolutely. The street is pretty slow, and we'll just see in the next slide that the fundamentals make a lot of sense, and hence the entire focus for this particular map session is majorly on India. Indian markets have been slow in the last month. They've kind of given 0.5% return. The broader markets have been a little bit more happier in that sense, but again, when compared to US, we've been slow. The idea here is that 1 month leader, or at least the last 1 year, let's say one of those leaders, may not be the entire cycle winner. We don't think the entire cycle is over. So for this leg, at least, we want to position ourselves in a way where the next winner is. If we look at what the fundamentals tell us, the fundamentals basically we look at the 3 parameters across every time. We look at the PMI data, we look at the GDP growth and the inflation growth. For now, the GDP growth for US has come in strong. We had the first quarter when we started the map session, we were at negative GDP. That Q1 of negative GDP has translated into like a Q2 of positive GDP. We were expecting the forecast, the street forecasted around 3.3%. We got around 3.8% as GDP growth. So that's quite good in a sense. So the economy is quite hot as such. So the growth is remaining strong. The forward-looking PMIs, the surveys which come in, they're kind of moderating a bit. We were at, I think, 55 last month. We are right now at 53.6 for US. However, the bigger worry here is that inflation is creeping back up again. So if your momentum is there and the GDP growth is strong, the entire reason for a rate cut here was basically that the labor market was shaky. It continues to remain that way. It's been a very slow labor market in US. Hirings are not happening that fast. Thankfully for now, there are no firings as such as in large numbers. But the labor market is quite wobbly out there. So we don't believe that at this point of time, it is too early to call for any soft landing. We still feel a lot of risk are pertaining to the system. We saw that when Jerome Powell actually came and cut those rates, he called it something called risk management, where earlier they were looking at inflation. Now they've started looking at the job market. We believe that when you switch that, you expect the economy to now kind of weaken a bit in a way. and with the tariff pressure, inflation may continue to remain sticky. So let's see how many the 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 forward path that Fed has given right now is of two rate cuts. There are two meetings left this year, and they've said that they might have two rate cuts by the end of this year. It looks a little bit stretched at this point of time, but given that how independent the Fed is, we're not as confident as we were earlier that how independent the Fed is of the government. We might have those cuts, but that will only prop back inflation into the picture. So given all that, US continues to remain a very dicey place. UK has the growth has barely been there. It's barely positive. Inflation has been very sticky, and the forward surveys of PMI don't look that great. Although in expansionary phase, 51 is an expansionary number. Anything above 50 is expansionary. So 51 is still an expansionary number, but they've been trending down. So there are risk of stagflation out there. China has been one of the better players when compared to US or UK in terms of both market movements, the market returns, and in terms of forward-looking numbers as well. So the PMI, the data, the forward PMI for China looks really good. They've been going like up, trending up. The GDP growth has been quite stable. The biggest factor here, or one of the most defining factors for China, is basically the inflation is negative. So possibly the only economy, or one of the very few economies out there with the negative inflation. They have uh, deflationary inflation as such. So this gives a lot of room to PBOC, the People's Bank of China. It gives them quite a lot of room to cut rates because the inflation pressures are not there. So if they want to prop back up GDP growth, they're quite in a very good place. So a lot of tailwinds are supporting China at this point of time. We discussed Japan a lot. Japan has gone through a lot of changes. They gave up yield curve control, which has been able to get back GDP. Their inflation has been on a downtrend because there were rate hikes, and but the forward-looking numbers don't look that great. And we do have a slide on this at least because there are a few issues in Japan as well. Eurozone very similar to UK, barely any growth out there. Inflation continues to remain sticky. Fortunately for Eurozone, at least, forward indicators look a little bit better, but the economy still remains fragile. So that brings us to India, possibly one of the most, like, it is the fastest growing large economy in the world. The inflation is pretty much under control. However, it's propping back up again. We had the RBI policy meeting today, and the RBI chose not to cut rates even at these low inflation. However, the stance was very, like, the voice was very dovish as such. They're ready to bring in a lot many changes to remain to first and foremost counter tariffs. GST has given us a lot of like the new changes in the GST last month have given us a lot of room to kind of given RBI a lot of ammunition in terms of to stay nimble as such. So although inflation is slightly edging up, but we're coming off from a very low base number, and when compared to GDP growth of such a high number, 2.1 is probably one of those good numbers that you want to be. We still remain, although on a downtrend. Last time around, we were at 63 PMI, which is the forward-looking indicator. We're down to 61.9, but 61.9 is still a huge number. I mean, anything above 60 is a brilliant number out there. 63, it would have been very difficult to maintain such a big confidence number as such. 62 again, not bad. So again, while all of this shows one thing, that global growth is kind of diverging. It's moving away from the west to the east. The west is struggling with a lot of sticky inflation out there, while Asia and the east is being led by India and Japan. The idea here is that east has much lower inflation at this point of time. And all of this comes from 5 years back. The response to COVID times. All of that is, I think, bringing in a lot of tailwind into the economies of China and India, and hence we feel that possibly the cycle is very similar. It's just that the leadership has kind of shifted to the eastern side of the world. When we were here last time around, again, this was just before the rate cut. Our last section was called "Wake Us Up After You Cut Your Rates." Um, when we discussed this particular chart, this is exactly same the last time around that we were here. We said that as soon as we get a rate cut or just before a rate cut, we would see a knee-jerk reaction downside. And then once sanity hits the market, that possibly is not the right direction to go into. The yield, the US yield, the 10-year, these are the 10-year US yields, these are the bond yields as such. So the minute the rate cut would, or just prior to rate cut, we would see a knee-jerk downward reaction. And the minute the sanity comes back into the market that possibly this is not the right place to be, it would the yields would start propping back up again. So, and the best part about this was that when Jerome Powell cut rates, he did not cut it for the right reasons. You generally do not cut rates when your labor market is wobbly. So that shows signs of a very like a economy that's not very strong. And this is what happened. We had this knee-jerk reaction uh, yields going down just as soon as we had this rate cut here. You know, the yields did go down, but as soon as market caught up that this is possibly not the right way to go ahead, the yields are back up again. They are testing around 415, 420 of the 10 years. As we said last time around, when we have this meeting like 9 to 12 months later, we don't expect yields to be at a 4.2. We expect them to be much higher than here, and that gives that again comes back to how independent the Fed can remain, how much they can, how much rate cuts can be put in without inflation flaring up again. Today as well, the yields are up because US government has gone into shutdown. So again, shutdown for US governments have been commonplace almost every October. We'll come to that too. But they have actually gone into a shutdown. It was not looking likely that it would shut down at one point of time. Just like 2-3 days back, it was at around 75-80%. The betting market was betting on a shutdown, which then dropped to 50% after Trump had acknowledged that maybe we would not go for a shutdown, but today they have. So that's happened, and then yields have dropped back again. You can't ignore the headlines here that you had a rate cut because of wobbly or a poor or a weakening labor market as such. So basically, if the labor market's weakened out, I think that's not the right way to look at an economy. And then when your inflation keeps remaining sticky at that point of time, you start getting back up again on the yields. So moving back to India, this has been our prime focus here today. We were hit by the H-1B visas basically this month, and this what we think was that earlier H-1B visas were around thousands dollars per visa. Now it's been up to 100K is what you will be charged if you raise a new visa request to go to India, to go to US from India. So if we step back again, how did Indians start going to US and working out there? We were earlier back in our 1990s, PSU jobs were very very common. We were hit by that by the Mandal Commission, and then the middle class of India, the large middle class of India, found a way of actually becoming talented and be in terms of technology talent started coming out in India. What we believe here is that with these increase in visa, at least just the entry level ones, margins at least in the IT sector will be squeezed. So there has to be a change in the model of how IT sectors work. IT, obviously, the day visas hike was announced, IT lost a lot of value over the time. From then on, IT is down like around 8%. It fell 8% in a week. And the IT sector has been kind of struggling throughout. We've been if you look at our if you have been attending MAP for quite a bit of time and have been looking at our reports, we've been underweight IT for quite a bit of time. The reason we were underweight IT was because of tariffs, and basically the H-1B visa. If you've just gone and read what the manifesto of Trump had said, they always wanted US first in a regard. So H-1B visa out there was hanging like a thread, and that's one of the reasons why we were underweight IT. However, this thing, we've always, as Indians, we've been very resilient in a way. We've always found crisis to become very creative, and hence what we think that the talent which India has and continues to have and will continue to have will actually help Indian IT to adapt and grow more at home. So this is kind of an opportunity in a crisis for us, at least in the IT sector. When we look at it from a lens of how many approvals were done, they were already on a downtrend. The projections for 2025 already showed that a lot less people wanted to go out, and basically the funding for homegrown talent here is supposed to increase. So again, from crisis, there is an opportunity as such for homegrown talent to come through, and this may eventually hurt margins today, but in the longer run, maybe we can become we've been lagging both US and China. Let's be honest, we've been not the leaders out there, at least in the AI technology, which we see. Let's take Chat GPT from US or DeepSeek from China. We don't have our own grown AI structure out there. So again, a lot of this helps India to build new new tech as such at home, and we'll have to take the brunt of it, and that is why IT has been falling. We continue to remain IT, as we'll say in the future slide, but at some point of time, once a little bit of clarity emerges, possibly IT could be one of those sectors where valuations make a lot of sense. So again, what began as a barrier has now become kind of a bridge in a way, where we have been incentivized to emerge as global hub for tech delivery. Another thing that happened in India, which were we were the pharma sector was hit by 100% tariff from US. However, the clarity here, or the thing here, is that um, US has taken 100% on branded drugs, not generic ones. So what India produces is more of generic stuff. Now, after this news, China came and said that the import duty of 30% has been reduced to 0%. So there is a new market that is opening up for Indian pharma, a much larger market in terms of demographics. Um, um, but however, the what we realize now is that obviously it does not you cannot build supply chains in a new country just on the fly. You need time to build those supply chains. However, the diseases or what US uh, population suffers through, they suffer through things such as obesity, cardiomeds, diabetes, cancer drugs, while Chinese market is more prevalent, or the more sale of pharma over there is of respiratory drugs or infectious disease, or very generic focus. So given all of that, again, we've got to be very, as autos were hit by tariff, and then we became very selective on domestic auto. Similarly, on pharma, we'll have to become very selective on the choices of companies that we pick up. Again, the larger portion here is that there is no clarity on generics as such right now. But given how we are going, possibly we'll be tariffed on generics as well. So again, something to look out for. However, um, pharma as a defensive sector continues to do well. In India continues to be the pharmacy to the world, and for us as the pharmacy to the world, an entire whole new population, a much larger population has opened up. It's just that the diseases that we were catering to before, now there is a whole new different, different drugs that we'll have to focus on. So that's what the entire pharma market does due to the tariffs on pharma. Moving on to some good news. So, in terms of the government acknowledged that because of tariffs, we've been hit. So, we've come out with an consumption boost as such with the rollout of GST 2.0. This is much more simpler, much more smarter, and much more strategic in nature. Simplicity is that earlier we were at 4 slabs, now we moved to 2.5 slabs. So compliances have become easier. So 2.5 slabs as such is a 5% slab and an 18% slab, and then you have a 40% slab for sin goods. So there is obviously a social tilt here. Obviously, your education and healthcare has become much more cheaper, and your sin products have become much more expensive now. So what we believe that based on this 2.0, and we just rolled this out on 21st of this month, and it's been a is that's the time then festivities have started in India. So obviously there is a consumption push, and we think that the winners will of this particular thing will be healthcare, FMCG, and the consumer facing companies as such. The revenue of this thing, this entire plan, is that the government then would end up losing around, or the consumers will end up saving around 48K. The entire math here is that 93K odd goes away, but the remaining gets back at least in the sin products, the larger tariff, the larger taxes on the sin products. So much more smarter taxes now. Um, Hopefully the end result of this is that they are translated to the final consumer, and once it is translated to the final consumer, then things become much more cheaper, items become much more cheaper. That spurs up demand, that spurs up consumption, and gives as things become much more cheaper, at least inflation doesn't end up spiking back up again. That gives RBI quite a lot of room to be nimble, and in that regard be more focused on be able to balance the economy. um, Finally, last month we discussed Japan at length, um, and post that discussion, within a week, we saw that the Japanese Prime Minister Ishiba had, made his resignation, um, due to the fact that he was not happy with the tariff deal that his team and him had signed with US. This adds to a lot of political uncertainty in Japan. This is possibly, I don't know, I don't think I have that many fingers in my hand to count the number of prime ministers they have changed in the recent past. But that means that there is a lot of um, political uncertainty as such. What we see though is that the path that the prime minister was taking and the Bank of Japan was taking was that of a rate hike. Now, why is Japan a very important uh, country in the world? Is because there is something which is called a yen carry trade. So generally, the idea is that you borrow at cheap rates in Japan and then invest at higher rates in US, and hedge your currency risk in a way that gives you almost a risk-free kind of a return. So if your currency bets are hedged, you can borrow at almost 0% from Japan and then invest at 3-4% in US. However, when Japan starts to raise rates and US starts to cut rates, that entire trade goes away, because now you cannot no more borrow at low rates, and you cannot invest at higher rates. That last year in August, that entire trade sucked out liquidity as such. Given that now that the resignation of the prime minister has happened, we expect Japan to continue to hold rates, no more raise rates. What we see in the past, that whenever Japan has hiked rates, a recession has followed within the next 12 to 18 months. So this has happened since 1980s. Japan as an economy, once they start raising rates, it becomes very difficult to for the entire world to borrow at cheaper rates, and that generally brings around a recession. This time around, they started raising rates sometime in early 2024. So we are within that 12 to 18-month period when generally a recession hits. 12 to 18-month period is basically an average of. It's not. There is no pin as such that you have to have a recession between 12 to 18 months. You can always have plus minus 6, 7 odd months as such. But this is something that we've observed previously, that whenever Bank of Japan starts raising rates, that generally follows a recession kind of follows. So Japan cannot be anymore a side story because increasing rates was not much favorable for the entire world, and hence if somebody actually does it, they might have to backtrack and keep rates kind of stable in a way. So how are we placed right now? Obviously, we've been hit with tariffs, but we believe that the valuations in India make a lot of sense, given that the markets in India have remained sideways for almost a year now. And with that, we we feel that the leadership is shifting towards the east, and India and China are leading from the front, and hence the entire way that we structured our kind of portfolios are that we've been overweight India. We continue to remain slight overweight on India. We continue to remain neutral on China, and then be underweight the West. In sectors, this has seen a major change this time around. We continue to remain underweight IT, as I discussed earlier on the slide that of the H1B visa slide. We are tracking this sector with like very closely now, given that the valuations have tapered off there, and if we start seeing green shoots, at least in terms of companies starting to build products in house and for the Indian audience and start leading, it could be one of those places where actually a lot of good players can be found. Moving to the ones that we've actually overweight. We've overweight almost every consumption story, durables and staples, obviously. And the other part is basically we are now overweight on reality. Reality overweight makes a lot of sense now that we feel that inflation possibly has completed its down cycle. So when inflation starts its up cycle, people like to hold kind of real assets, and in that regard, reality makes a lot of sense to begin with. We continue to remain slight underweight on auto. However, we are very selective there for companies which are domestic facing or non-US facing. We continue to be overweight there, but those which are facing, which send OEMs or other things to US, at least in the auto sector, we're not looking at those companies at this point of time. Looking at debt, we continue to remain neutral on debt. Today, the policy was dovish in a way, but there was no rate cut. However, again, coming from the sense that if the inflationary cycle has gone through has made a bottom and such, if we're moving to a world which is slightly a little more inflationary in nature, then we don't want to be overweight debt. And in terms of cash, we are slight underweight cash, deploying it strategically as and when we find opportunities. And I think any conversation right now over the market cannot be complete without talking about gold and silver. This is when we actually thought gold and silver made a lot of sense. So these are these are our articles from LinkedIn. Back in Jan 2024 is when we thought gold made a lot of sense. That time gold was trading at around $1,900 an ounce, and then silver is last October is when we thought that silver made a lot of sense when it was when in Indian rupees it was translating to around 85,000 rupees a kg. So that is when it made a lot of sense. Right now, I don't think I've attended any party of late which has not talked about gold or silver. So that gave us an opportunity that we go back and look at past bull cycles in gold. The largest bull cycle that we know of in gold happened between 1970 to 1980. That was also driven by another central bank. So right now, a lot of news tells us that, a lot of data tells us that gold is in a major bull run because central banks are buying it. The last time around that gold went into a bull cycle between 1970 to 1980s, 1979-80, was because another central bank, the Fed, the US Fed, gave up like on the Bretton Woods system, and the dollar was no more backed by gold. So in that time, if you actually look between 1970 to 1981, gold made a massive run up. What we've done is we've rebased both, and that was a 10-year cycle. What we think that this gold bull cycle is again like a 30-year bull cycle, which possibly started in 2000 and continues till date. If we actually look at it, it makes a lot of resemblance to the cycle that happened in 1970s. Um, and we and when we actually look at it in that lens, uh, gold does go through a lot of stagflationary times as well, like a sideways movement as such as well. Right now, it looks quite euphoric when your hedges, generally gold and silver, your precious metals, are to hedge against things like a bad outcomes like a recession or something like that. But when there is no recession outside right now and it becomes kind of euphoric, uh, it becomes too overheated to hold for us, at least. When we actually see better opportunities and equities, again, when we combine both these bull runs, we see that we are very possibly, again, these are weekly things, so there is still some bit of room to run for gold, and possibly by the end of this decade we could see much higher prices. But for now, at least, they're tracking what they did back in 1970s. So having said that, moving on to this month, October remains from 1945, from the end of World War II till now. When we actually look at it, October remains one of the most volatile months. As such, the volatility for October is 33% higher than any other month. So generally, this is the time that major shakeouts happen in a market. We kind of seeing that across at least the Indian market, and that is why you cannot avoid this volatility, at least. At least if it's cyclical, and if a month is particularly more volatile, you can't avoid it. But when you look forward, at least if you look what happens after October, if you look at November, December, Jan, Feb, March, April, May, and June, if you look all of this, your volatility kind of comes down quite a bit. So this is possibly one of that admission fee that you have to pay to be a part of a cycle which generally becomes less volatile as you go forward. So with that, obviously, this is possibly a month that major shakeouts happen. The major panics that have happened, at least in the month of October. So anything that triggers it, we've seen that markets generally make a better rebound post October, and you generally have a decent low volatile period after October. We did ask for a few questions, and what we were asked was basically a very interesting question. We've heard this question so many times now, that how do you trade this market? Because obviously it's been one of the more difficult market. Even in Money Nest, we kind of saw that the market was kind of the major question that we were asked, that we've not been able to make, we've not been able to ride, or we've not been able to make money in this market. It has been tough. There's no denying the fact. Over the last 1 year, the market's possibly gone nowhere. It has gone negative rather. But what we see this is that this is like the common typical cycle of a market. This is how markets are generally. A lot of these questions come from investors who've started looking at markets since 2020. So from 2020 to 2024, you had a market that had a lot of momentum in it. It was much more easier to make money. Now it is a market which kind of requires a lot of tactical positioning. So if you ask us that how do you trade this market, the easiest answer is that you open, you start a goal at Llama Research, and then we'll do the tracking for you. If you want to do it the hard way, then the idea is basically that this is where we were last time on map when we were asked the same question, and we said that there was a small demand zone here, and which we had kind of deployed all our cash, and equities was a large portion for us. And we said that there was a supply zone which was on the upside. So demand zone is where obviously there is a demand for equities, and supply zone is where there is resistance for equity. So what we saw was that we were heading towards this demand zone, and then we deployed entirely of our cash and went overweight equities. What we saw from there on, and this is where we were at the beginning of last month. So obviously that demand zone was respected, and then we went up to the supply zone. This is where the market faced resistance. The demand, the rally kind of fizzled out, and now you're again heading back to that demand zone. So what we did was basically again we were entirely invested in equities here. When we reached the supply zone, we raised some bit of cash, reducing our equity exposure. As we head back into the demand zone, what we are doing is again increasing our equity exposures, but this time around we're not using the cash, we're kind of reducing out our precious metals. So given that they are kind of euphoric, so we've been able to capture that kind of an upswing there, and that gives us a lot of room to at least go back into equities. Given that this is the multiple test here in the demand zone, there are chances that the demand zone may not kind of like the number of times you come and test there, the demand kind of fizzles away there. Then you have a very, very, very strong kind of a demand zone just right below it. So that gives us a lot of more confidence in terms of risk management. Here, if this fails, you've got a very strong demand zone just right below it. So for that reason, we continue to be overweight on equities. Given that if this demand zone holds up, we don't know, but if this holds up, then the risk reward is much more in favor. You kind of again, if this does not hold, then you have a demand zone just right 3% below. But given the fact that your supply zone has also been tested multiple times, both the sides remain like the supply zone is also fizzling out. The more number of times you kind of go and test it, the supply over there finishes off. So for us, at least, the risk on the downside looks very limited, while the reward looks very interesting. So for that reason, we've kind of ended up with a higher weightage on equity. And given that we've been able to, hold gold and silver, your precious metals, for quite a bit of time, we've reduced that out. We still continue to hold some bit of cash, given that if there is a possibility if this demand zone does not kind of hold and we head into here, then we can use up this cash as well. This is how our performance has been from the last 30 months that we've been managing portfolios. These are the performance for Llama Research's portfolio. The entire range, given that we treat all our clients differently, given where they are in their financial cycle, and we've been able to outperform both Nifty and some, like most of our portfolios have outperformed gold as well. So we continue to do that. We continue to stay nimble in a market which continues to be sideways, and kind of test out test out possibly everyone. So if you think of this market from a test match perspective, I think the first 3 days, or we're possibly in the last session of the third day. This is the session that if you end up losing wickets, then your kind of the next 2 days become very difficult. But at least the first 2 days, when the pitch is much more easier, the runs are easier to come by. I think we passed that stage now, and possibly we are in the last session of day 3. On day 4, obviously the pitch starts turning much more than it usually does on the first 3 days. So again, markets would remain volatile. You will have news flows coming up, and that is why whatever we've kind of discussed here, we'll recommend that you speak to a financial advisor to take those next steps, because again, the easier money has been made, and the market going forward would be much more difficult as such and would continue to remain volatile. That's all for me. If there are any other questions that we could answer.
So Karan, I have one question. Considering that October month, like you said, historically has been volatile, do you think it's the right time for like new investors to come in and start their investment journey in October, or do they just wait for a couple of months?
Yeah, so October generally is a difficult month. The volatility is much more higher in the US markets than Indian markets. So if this question and again, this is an historical data. What we've seen is that last October, India, we did not have a very good market, at least in India, right? And
Mhm.
given that entire last 1 year, almost 13 months now, that we've not had a market that has, like, we've had a market that has gone nowhere. So given that, and with valuations intact, and with risk reward in control, we feel that any time is a good time to start as such, if you are doing it with risk and control. I think we've discussed that risk on the downside is much lesser right now. We think that given historical, again, it's because it's happened in history, it does not need to repeat itself. But it's just a warning out there that, this has happened. This has happened in the past. So if you find yourself in a shakeout, don't get worried, because easier times generally come past October.
Got it. Okay.
Right.
Thank you.
Hi Karan, am I audible?
Yeah, I do. Yeah.
Yeah, the session was really informative. Just
Thank you.
wanted to ask, you mentioned that you are underweight on IT. So I just wanted to understand right now, as you mentioned, that the IT sector is hasn't been performing for quite some time. So wouldn't it make sense to add more IT stocks as they are available a little cheap? And so just wanted to understand that first.
Sure. So, thank you, David, for the question. You have to understand what Indian IT serves at this point of time. Indian IT serves mostly services, right? And services, given the advent of AI that we've seen, these kind of services are replaceable in a way, right? So we have to become much more deeper into tech to be able to challenge what the world is producing or our competitors are producing at this point of time. Given that, given that story, valuations at this point of time do not look that attractive. They're better than what they were at least 12 months back. Uh, but given that you are facing three multiple risks, right? You have tariff, you have the H1B visa thing, and then you have the advent of AI. All of these three things all together, you could we will want to continue to wait a bit more to seek some clarity uh, before looking at. We continue to remain positive on IT from a longer term perspective. Like if you were to ask this question, let's say around a year later, maybe we would actually find really good places to invest in.
Got.
Yeah,
Thank you.
thank you so much.
Yeah, hi Karanji.
Hi,
The
hopefully.
yeah, the it was a very good, very informative presentation. Just wanted to ask you that the US Sensex, I mean US index is basically dominated by the IT companies there, basically
Yep.
the AI and the data center play and everything.
Yes.
So isn't it better to have a concentrated bet on only those few companies who are dominating there? That's part one. And part two, are there still some space or something left after such a massive rally which they had in the recent past?
Okay. Yeah, thank you so much for the question, Bikaji. So
Yeah,
the thing here is that what you are referring to is basically the Mag 7 out there.
yeah,
So
kind of.
Nvidias and Metas and the Apples and the Googles of the
Yeah.
world. So yes, they've been on a tear since almost like a year or so, and that has raised their forward PE to 24 times. So we had this thing from, I think, last time around. Just give me a second. I'll open that up for you. Mm.
Yeah.
This was our September session, and here we kind of I think we discussed it a month back. No, yeah, here, right. Sorry. So I think this is what we discussed last time around, that the valuations for US, the forward valuations are at 23.5, 24 times. Generally in history, whenever we've seen valuations reach here, the forward, these are returns over the next 10 years. So the returns over the next 10 years have not been very kind to investors. So this is where you are, at least in terms of valuation wise. Uh, given that they have been like running non-stop as such, we at least are underweight the US market as such. Um, but we have to understand that why the markets over there are going up. They're going up on the basis that a lot of people are expecting rate cuts to come across. That's possibly not the right reason to invest into a market. So some bit of cooling down over there would at least make their markets a little more attractive for us. At this point of time, we would avoid something that is at an expensive valuation.
Okay. Got it. Yeah. Thank you. Thanks,
Thank you.
Saran.
Thank you. Thank you so much all for your time.
Once again, Karanji, once again.
Sure.
You said it's not you would remain underweight or probably neutral on the US market. What if the investment is already made? Would you recommend that it needs to be reduced?
Like if you're already invested into the markets in US, the markets over there, we feel again at the valuation that they are would be a better way to book profits out there. Obviously, if you are already invested there and how the markets have behaved there, um, you are sitting on some bit of profit there. So it's a good profit booking opportunity as such for to reinvest into the market. However, if you actually see the US markets, the markets are on a tear only because of these Mag 7, like all these
Correct. Yeah.
Nvidia. Then the smaller companies out there, the ones which are also innovating a lot more, they have not been priced in properly. So I wouldn't be entirely out from US market, but I would actually want to recalibrate in a way where you look at companies which are not in like in the headlines right now, but are doing really good work. So there are companies again, if you were to mention companies like data storage companies, Celestia, Seagate. There are other companies like ServiceNow. There are other companies, network companies like Arista Networks. So all these companies make a lot of sense given that valuations there are not as euphoric as those for Mag 7. So so again, we would structure a US portfolio in a much different way than how Nasdaq is structured right
Okay. Kind of reshuffling. You
now.
mean?
Absolutely. Yes.
Okay. Yeah. Thank you so much. Thank you.
Thank you, Vikas. Cool. If there are no other questions, then thank you for your time. Thank you. It was lovely hosting you today. And again, October, however volatile, leads to much better months forward. So if you are caught in a shakeout, don't worry. This is normally a normal cycle for the market. Uh, Given where we have seen Indian markets over the last 13 odd months, we feel we are at a very good position in terms of risk reward ratio. The risk on the downside look way minimal, and on the upside, obviously you have much higher, almost a blue sky above the all-time high of 26,200. So again, risk reward is much more favorable, at least in the eastern part of the world, than the western part of the world. So yeah. I think thank you for this, and wishing you all happy festivities going into October. Thank you so much.
Thank you so much. Thank you.
Thank you.